Hey, this is Brant from TradeGuild.net and Wolf on Wall Street. It is just after the market closed, January 28th, and we're looking at the QQQQ, which is the ETF for the NASDAQ 100. And what we're looking at is a ascending wedge over here, which is a bearish pattern. It shows up a lot better on an intraday chart. And we're going to take a look at 3C, which is my proprietary indicator. It kind of ferrets out accumulation and distribution through positive and negative divergences. So let's go ahead and take a look at the Qs over here. We can see is that wedge over here. Now it's really common. There seem to be these black box systems that look for these kind of patterns, right? In technical analysis, we know that a wedge, when it comes to its apex, basically is supposed to break down like this. And a lot of people will get short this wedge before that, anticipating that breakdown. These black box patterns, they go ahead and basically run or break out, in this case, the wedge. So anybody who was short that is now at a loss and they've got to cover. It just helps the downside momentum, but we see this every single day in really common patterns in larger stocks, not so much in the smaller ones, but anything that's a triangle, a wedge, a rectangle, you can almost 85% count on a false breakout. In any case, what we're looking at is the negative divergence that formed in this wedge. It started over here, and it really got bad over here at the highs, okay, at this breakout. So this is pure distribution. So they're selling or going short right up here. And when I say that, I mean institutional money. And then we also get a little bit of a positive divergence. It's called a relative positive divergence because we have two relative points here at the same price, and 3C is higher at the second one. So this shows us an area of accumulation over here, and from there we see the Qs go ahead and move up. Okay, that was during this week, and I kind of had a theory, and what the theory was advanced GDP was coming out on Friday, and if you're going to rally the market, you're going to do it earlier in the week and midweek if you're expecting the GDP to come out with bad numbers. And we know that we're way behind the information curve. But from what you see here, none of this stuff is random. This is all planned out. So there's people, I believe, that are ahead of the information curve and had the advanced GDP way before we did today. So what we're doing is looking for that kind of stuff, and it turned out to be right. Coincidentally or not, I don't know. We're looking at the 5-minute chart now, and this is where we can start to say, okay, we know we're getting close. We're seeing that negative divergence right into the very highs at the close yesterday. This morning, we see a straight line down. Now, of course, there's events that influence that, like Egypt. We saw the accumulation. We started to see the distribution. We fine-tune it with our shorter term charts, like this 5-minute chart, even a 1-minute chart, and we can get a pretty accurate estimation of when we're going to see a reversal. Now, if I go ahead and jump to the IWM, which is the ETF for the Russell 2000, and I use a different version of 3C on the IWM, we're going to look at a 30-minute chart, and what we see is largely the same thing. We see this positive divergence into the beginning of this week. Here's our relative areas here and here, and here's our positive divergence as 3C moves higher. If we were to back up a little bit, we see the same thing that we saw in the Qs, that negative divergence right here. Now this is a half-an-hour chart, so this is giving us the broad strokes. It's showing us quite a bit of accumulation here, so it's basically about a week's worth of bounce there. Now what we want to do is fine-tune it and look for the distribution that we see there. So I'm going to go ahead and jump to a 15-minute chart, and again on the 15-minute chart we see that confirmation of the positive divergence over here going into the beginning of this week, and we have follow through, which is confirmation, higher highs with price in 3C. And then when we move into the highs yesterday, we get a very negative divergence. At 3C, it just goes straight down. And then today, we get this drop, and 3C confirms this drop. So we saw both of those occur in the Q and the IWM. We also saw it in Dow and the SPY. They all tend to move together a little bit differently, of course, but they say a rising tide lifts all ships. We had quite a few trades that yesterday didn't look so hot. We looked at 3C, and today we decided to stick in those trades, and today they're up 7 and 8%. We had quite a few great trades this week, so if you want to check it out, go to tradeguild.net. You should be able to see it down here. Look at the top right hand corner of tradeguild.net site, and you'll see information about Wolf on Wall Street and how to subscribe for our members. A lot of benefits for the members, a lot of really great trades. We've had a lot of double-digit days, making 30% in a single day with a lot of trades and a lot of great trending trades. So take a look at Wolf on Wall Street, and this is Brant from TradeGuild.net. I wish everybody a great weekend.